Hello, everybody. I'd like to welcome Matthew Abraham from Homestar Financial today, and he's going to help us talk about some of the financial pieces of real estate. Matthew, what does Homestar do?
Homestar is a mortgage company, so all we do is provide home loans to people to get into their first home or their second homes, investment properties. We are the largest mortgage lender in the state of Georgia.
The largest. That's awesome. So all of these other guys like Quicken and others, which say they're the largest in the country.
They would be nationwide,
Okay.
but we, as real estate is very local, we're built to be a very local lender here in Georgia. So we're
That's-
headquartered in Georgia and do all vast majority of our business in Georgia.
That's awesome. Well, that's great, and we all appreciate that. Hey, so let's talk about types of mortgages and why people would pick one type of mortgage versus another. There's lots of different types and lots of different rates and lots of different locks and all these kind of things. Let's try to make it a little bit simpler for people, and let's just talk about the general types first, and then we'll kind of maybe go in a little more detail.
Yes, so you have government loan types and you have conventional loan types. So government loans are your FHA, VA, and USDA loans. Conventional is your Fannie Mae and Freddie Mac loans that are done by those two large government entities. So the FHA loan is designed for maybe people who need expanded credit, a little bit better credit risk. So it's designed to get more people into home ownership.
Okay.
USDA is a really designed to give rural America housing and designed to do it with no down payment. So it makes it a lot better. VA is entirely what it stands for. It's there to serve the veterans. It is 100% loan, great loan for veterans. So it's definitely the best product to put a veteran in. And then the conventional loans are designed to kind of cover the rest of folks that maybe are buying investment properties, second homes, or maybe selling a home and moving up into bigger housing or something of that nature. So.
Okay, great. So as a home buyer, how do I decide where I want to go? Who do I need to do that, or will you help us do that, or what's the process in that happening?
Right. So you want an experienced loan officer from a mortgage company to help you decipher your needs, and then they will decipher the thousands of guidelines that exist to determine which one of these loan programs fits your needs. That's the number one best way to do it.
That's true, because I can attest some of the VA stuff can be very complicated, as we know, right? And so I think the point that Matthew's making is experience is vital in the money game, and understanding the money game is not only understanding the types of mortgages, but the regulations and who applies and who deals with and when. So there's some other things about rates and locking and points and those kind of things. Kind of give us a quick overview what that really means.
So there's cost. There's cost to getting a loan. So we have one big number called cash to close. That's the amount of money you pay at closing. And cash to close is going to be made up of three parts. Your down payment, if you're required to have one on the loan.
Okay.
It's then going to be made up of closing costs, and those are fees of the loan. So fees of the transaction, actually. So you got lender fees, you got appraisers. In the state of Georgia, you have to close with real estate attorneys, so you have attorney's fees. The state of Georgia itself charges you fees to buy property. And then you also have fees that are costs that is your escrow account most of the time. You have to cover the county taxes, and you have to insure your home with homeowners insurance. So when you put all of that together, you have something called cash to close. And that can be adjusted based upon your property, upon the loan type, upon how much the seller can help pay towards some costs. All of that has to be built into an analysis.
Okay, great. And you guys, as the mortgage brokers, do that analysis.
Right. Very important that you work hand in hand, the real estate agent, the buyer, and the loan officer work hand in hand to figure out how to best meet the consumer's need.
So is there any special types of programs that a mortgagee would be looking for? Like I've heard of Georgia Dream and others. What's the deal with those guys?
So those would be called, we call them down payment assistance companies or entities. They're normally ran by the city, the county, or the state. And this is true across America. This is predominantly true across most America. So the city programs will cover if you live in the city limits. The county programs will cover if you live in the county. And then the statewide programs will cover if you live in the state. They are very restrictive most of the time around household income. They're very restrictive around debt to income ratio and credit score. But if you can fit into their box, they are a way that you can get sometimes free money to cover your down payment, like on an FHA loan, or sometimes you do have to repay it.
Okay.
So there's a few other programs that exist out there as well that are more nationwide programs. The number one program being what we call the Chenoa program.
Okay.
And that's designed to be a little bit more easier to qualify for than maybe some of the other state, county, city programs.
And so by being easier to qualify, there's typically a caveat to that, right?
Yes. So instead of the county program may say you can only make $50,000 a year, the Chenoa program say, oh no, you can make $96,000 a year.
Okay.
Something like that. So they just design exceptions to those other rules that exist predominantly in the down payment assistance companies.
Okay, but is that done for a price basically?
It
It's a fee.
is. So,
Okay.
yes. So they're trying to make more of a profit where these other programs are funded by tax dollars.
Got it.
So they can be more cost than that associated with that.
Okay, great. So one of the things I run into with buyers when we go out is they're not they don't understand cleanly what the difference between a pre-qualification and a pre-approval is in the mortgage process. Could you explain that for me?
I would say there's probably a lot of mortgage companies that don't understand the difference between a pre-qualification and pre-approval. So that is actually a terms that come from a federal law, the HMDA law. So pre-qualification is where me and you and the consumer basically speak and talk verbally, and we basically enter information into a computer system, and we basically have made an assumption of based upon data what someone qualifies for.
In other words, the information they gave us.
That they gave us, right?
Okay.
It's all verbal, right?
Okay.
But as with anything, there's the facts on the ground, right? So the documents and the stuff. That is when we start moving into pre-approval. Pre-approval is where we actually start underwriting the loan and getting it approved before you ever find a property.
Okay.
So, and that is the best way to do it.
Okay.
Many people come after the contract to try to find their lender and get turned down and lose their earnest money and stuff like that. It is a lot better if you'll go through the pre-approval steps, because you can then know that we've looked at your documents and validated your data to make sure that you actually meet the parameters of a qualification. And a pre-approval can be good for about 4 months. So it's not like it's...
Is there any fees associated with getting a pre-approval?
No.
Through your process?
Nope.
Okay.
Cool. Most mortgage companies, few charge application fees, but especially a company like our size designed to serve Georgia home buyers, there is no fee cost at all.
Well, and as a realtor, one of the things you're always looking for when we have a listing is a qualified buyer, right? I mean, that is the golden goose in the sense of the term what we're looking for, right? Talk to me about your credit score. People all have this fear of even understanding what the credit score is, never mind knowing what it is. What do you guys look for in a typical mortgage, and how does that affect your mortgage and your rates and your costs?
Right. So credit scores in the mortgage industry are all about gauging risk. So it is actually not what determines whether you get a loan or not. It determines your availability to the programs and loan types, and then the cost associated with those loan programs and loan types. So there is mortgage credit scores. There's multiple versions of credit scores. So there's a mortgage credit score through Fair Isaac that the mortgage industry use. It'll be different than Credit Karma and the rest of those things out there that are for the consumers. Not entirely different, but just different.
Can the consumers get that information on their own?
They can, but they'd have to go to Fair Isaac's website and buy their Fair Isaac score, and you'd have to buy the right version.
Got it.
Of the Fair
So
Isaac
there's a fee associated with
Yes.
that. Okay.
Yes.
Okay.
And there's no fee if you use a lender or a
Okay.
mortgage guy, especially someone like Homestar. We just pull it
Okay.
and give it to you.
Perfect.
So credit scores are in buckets: 580, 600, 620. 640, 660, 680, 700, 720, and a little bit higher than that. So if you're in the 700s, you're in excellent credit shape. Your credit scores are going to be fine, and most likely there's nothing inside of your credit that's going to be derogatory enough to disqualify you for a program.
Okay.
If you're in the 600s, means you're kind of building credit, but you're probably still mostly okay. When you start going below 640, that's going to start pointing that there is challenges in the credit. Late payments, recent collections, recent charge-offs. And those things are stuff we're going to look at. Remember, I look at a lot more than the credit score. I'm looking at what is making up that credit score.
Okay.
And some of those things can disqualify you for a mortgage, or some of those things people assume they disqualify you for a mortgage, and they absolutely do not. I get that a lot on, I had a car repossession 4 years ago.
Okay.
Well, that's affected your credit, but that doesn't necessarily mean I'm addressing it from a mortgage perspective.
Okay.
So,
Cool. And you guys, as the brokers and the analysts within the bank, the mortgage company, go figure all that out.
that's right.
And communicate that back to the potential buyers.
Right.
Right.
So yeah, it's an analysis. So it's not even the computer systems. That's why you look for experienced personnel
Mm-hmm.
to do this, because you need somebody who has putting their eyes on something that they've seen before.
Got it. Perfect. So another big thing in the mortgage business, obviously, we hear a lot is your debt to income ratio. And number one, what is it? And number two, why is it so important in the mortgage business?
So I always try to explain to people debt to income ratio. If you were going to give somebody $100,000, you would want to know they have the ability and the income to be able to pay it back. That's all a debt to income ratio
Right.
is. It is a ratio to how much debt you have versus how much income we can qualify for you on your income sources to determine if we should lend you $100,000, should we lend you $200,000, or could we lend you $500,000, right? And that is literally all it is. Your debt to your income.
Mm-hmm.
Now, where it comes different is income has to follow a certain set of rules before we can use it as viable income for the loan, and that's where things begin to change and have different ideas about income.
So we don't end up in the 2008, let's blow
That's
up
right,
the world.
right. So yes,
Okay,
that's
right,
right.
okay.
So we actually want to document income. So
Got it.
believe it or not, somebody decided that that's an important thing. So
Yeah, everybody who lost a home in 2008.
that's right. That's
Yeah,
right.
cool. And so when we pick a mortgage company, what are the top three things that are the most important thing that you believe? Because we all have somebody we know or somebody who says they're in the mortgage business, but what are the three things that really make it most important to deciding on what company you're going to work with?
Right. So I'll use my 21 years of experience. So I've been doing this since I was 17. So I've literally never done anything but look at a mortgage. And
Okay.
so you want to know that the person is experienced and knows what they're talking about. They have seen different people. Everybody's financial situation is different, and you have to understand their financial differences to make sure that these guidelines written by large lawyers, banks, institutions, government entities, that person, so experience is key.
Okay.
I cannot testify to that enough in how many years I've seen people get taken advantage of because of people's lack of knowledge. You want someone local that you can deal with. Many people are out there that be honest with you, some of these things are even outsourced to other countries,
Okay.
and you can't. Those people can't understand your local real estate market and the local customs and traditions and the local. Is the seller going to pay closing costs? Is that
Right.
customary? So local is important. And then I would say, third, it needs to be somebody that, that you can work well with, that is communicating. Communication is probably the number one thing that makes all of this go wrong between the realtors, the loan officers, and the borrowers is the lack of communication. So being local can help with that, but also just someone that you are trusting and having good rapport with and communication is important. Rates are important, costs are important, and to me, the first three things is what makes the deal get done.
Right.
It doesn't matter how cheap the rate is if it doesn't ever
Right,
close.
it doesn't matter. Exactly. Well, I will attest to Matthew's statements there. I've worked with him a number of closings, and I will tell you that when you call him, you get a response instantly. And if it's not an instant response, it's an email or a text back that says, I'll call you at a specific time, and it's done. And I've had clients that have come back to me at the end and basically said, that was one of the best decisions I made in getting a mortgage, was having somebody they could constantly communicate with that wasn't passing the buck and wasn't passing them off as somebody else. So Matthew, I'd like to thank you for your time and your patience in working with all of us, and look forward to seeing you again real soon at the closing table.
Been fun.
All right. Thanks. Appreciate it.